The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box. I'm Karen Cho with Arabi Legamede. These are your headlines. Data weakness continues to dog the Chinese economy. Consumer inflation unexpectedly slips in September, while deflation deepens at the factory gate. Choppy trade in Chinese markets as the country's finance minister insists there is ample room for more stimulus, but leaves investors hanging on specific details.
JPMorgan and Wells Fargo kick off earnings season with a bang as JPMorgan tops forecasts, while Wells Fargo also posts a solid beat on the bottom line. The UK diffusing a row with DP World on the eve of a key international summit in London as the government prepares to unveil what is said to be a £50 billion set of investments. We'll be speaking to Aviva CEO Amanda Blanc. That's happening at 7:30 BST. Stay tuned for that.
And auto executives gather for the Paris Motor Show with the sector reeling from a series of profit warning amid weakening demand and rising Chinese competition. We'll speak to the CEOs of Citroën and Dacia later this morning.
Big broad measures from the Chinese over the weekend in terms of communicating with investors. A press conference on Saturday, so really ripping up the rundown in terms of when they're scheduling some of this commentary. But the market didn't get a number. They were looking for a specific number, and that was to the tune of up to $1.4 trillion in the range of 283 to 1.4 trillion. But that simply was not offered by the Chinese. And even going into the weekend, we knew that there was a whole blueprint for how these type of plans get approved, and effectively the rubber stamping required from Parliament. That is still down the track. So the market was saying, will we get the number or won't we get the number? They simply didn't. So interesting to see what happens now, because I think we've seen somewhat of a fade on markets that have been looking for extra just meat on the bones, trying to get ahead of the stimulus story.
But is China holding back? And I say that just because they keep being able to announce measures as well, right? I mean, let's not forget that they're set to also just put out another set of measures as well today, where there's an anticipation of more that could still come out of China, right? So are they just continuously just pressing forward and saying, well, you know what, we still have a little bit more firepower, we still have more to add? So much so that it's meant that even Goldman Sachs has come out and said, well, actually, just because of the raft of measures you've already put out, we actually think that real GDP in China could actually rise to 4.9% from a previous estimation of 4.7%. So clearly there's somebody who still believes in that story and saying that there is still some growth potential out of that. So how much more can they do and how much more will they do from here is perhaps what the market is looking for.
I think if you look at the sentiment, though, internationally, there's been money that's been moved off the sidelines. That uninvestable sign has come down now. And that's the thing. You've had almost 14 billion invested since the 24th of September. So in terms of inflows, you've had a real rally, feel-good factor around what's been announced. Is it enough to stick? And that's the question. Would anyone write China off at this stage? Because we know they're having a whatever it takes type of moment, a Mario Draghi type of moment going on. Yeah. And just because we didn't get a number, are you willing to now shut down those portfolio exposures because you didn't get a number, or you're willing to stay invested? So have they done enough to keep some of that money sticking in the economy now? That's the big question for me.
This is a very quick one. We thought there wasn't going to be anything that stuck necessarily on the bank earnings stateside.
Yeah.
What was all the fuss about?
Yeah.
Clearly things are actually still looking a little bit robust out of
We're getting
that
a soft
bank,
landing,
right?
Apparently, or no landing at all.
Yeah.
We're going to push on. Consumer price inflation dipped in China in September, coming in at 0.4% for the year and falling short of expectations. That is down from 0.6% in August. Producer price inflation sank almost 3% on the year, more than expected and well beyond last month's 1.8% decline. Chinese equities whipsawed and early traders respond to signals from the country's finance ministry that more stimulus is on the way. The finance minister told a briefing Saturday that the country will issue more debt to boost its beleaguered property market, but didn't offer much detail.
我们还有其他政策。
There are other policy tools that are being discussed that are still in the pipeline. For example, the central budget still has ample room for raising debt and increasing deficit.
Quick look at what commodities then are pretty much looking like then at this stage. Of course, we had seen a significant rally higher then for both the Brent crude and WTI of late. But this morning then going down more than 1% for both of those then Brent crude as well then as WTI falling more than $1 per barrel then this morning. Worries again about falling Chinese demand off the back of the data we've just been speaking about, disappointing Chinese inflation, also a lack of clarity perhaps then on Beijing's economic stimulus, raising a bit of fears there. Spot gold pretty much flat then, but remember that it actually reversed an earlier dip from early this morning, now sitting close to that 1 week high that it hit on Friday. Quick check-in as well on the greater China markets then, while Hong Kong is indeed, yes, closed, but the overall China markets, this is what we're looking at then, an uptick across the board for a lot of the mainland markets there, while the Hang Seng index is down 0.33%. Interestingly, looking at the property stocks, those have actually managed to rise as investors bet that the latest stimulus measures could perhaps aid some of that ailing property sector. More than 1% higher, though, for the CSI 300, the Shenzhen, as well as the Shanghai Composite. Let's head on over now to Sam Vardis, who joins us for a little bit more just on this one. Sam, just all about clarity. They say the devil is in the details. Where was the detail?
Very good morning to you, Arabella, and also Karen. I mean, we're never going to really get a quantified fiscal package from the Ministry of Finance because they, as the folks over at Macquarie have clearly pointed out in their note today, cannot meet unrealistic market expectations. And what they mean by that is that they are not able to give any sort of number that the markets are looking for, because that does need to be, as Karen was pointing out, rubber stamped by the NPC, the National People's Congress, which will be meeting at the end of the month. And so we were never going to get any sort of expansion to budget or extra bond issuance as far as numbers were concerned, because the market's been throwing out there everything from 2 to 10 trillion yuan worth of a fiscal package to support the economy. But the best that they can do right now is to give forward guidance and at least encourage the markets with some of that signalling and that messaging that they do intend to help things out. And two of the areas where it was very clear that they intend to address is some of the risks in the economy, and that is also around local government debt and the housing market. So there were four major sort of takeaways from this. A lot of that was around actually expanding or raising the debt limit so that they can help out some of the local governments with their hidden debt risks, and also special treasury bonds to help out the property sector, stabilise things over there with regards to snapping up unused land, and also to, of course, mop up some of the housing inventory, but then also to help the banks with recapitalisation. We know that they've been caught between a rock and a hard place as well, trying to support the economy and the housing sector while trying to protect their asset quality, and also as they face the pressure on NIMs as well. But then also was a pledge of, sort of fiscal spending to help out those low-income earners and also students. So, this was a package of support measures which are likely to be sort of rolled out as and when. But as far as sort of concrete numbers, this is likely to come, as I said, from the standing committee. So we await that. But as far as the market reaction to all of that is concerned, it does very much look like there are diverging views out there. I mean, we were just having a fascinating debate between two investors on street signs in Asia this morning who saw things very differently. So, the market's pretty split on, whether they're disappointed or whether what we got from the MOF actually met expectations. But it does look like, for now at least, the anticipation for more sort of incremental steps is helping fuel the rally at this stage. And I suppose what we're seeing here, this sort of split between the Hang Seng H shares and then also the A shares on the mainland, is very telling of perhaps what onshore investors are being encouraged by. And that is a lot of the sort of financial commentary and the local media reporting within China that seems to be sort of peddling this message that don't get over your skis with some fixation on a magic number. This is about incrementalism, and this is also about patience and also to have a bit of faith in what we're doing here. The trillions will come. You just have to wait for it, because we're not going to come out with any sort of big bang policy announcement or any sort of big number. We will do it sort of as and when to address the various concerns within the economy. But of course, we did get the inflation data as well, and no doubt that was supporting some of the concerns, which very much warrants some of the fiscal stimulus that they're talking about. Let's see how far that goes to sort of stem some of the deflationary pressures that data continues to show that the economy is facing. And then, of course, we are waiting the trade numbers as well today, guys. It looks like the folks over in Beijing have delayed that this morning, and there will be a press conference happening at 3 p.m. local time for an update on that. I'll send things back to you.
Thank you very much for that, Sam. Let's get to Raymond Cheng, who is CIO North Asia Standard Chartered Wealth Solutions. Raymond, to pick up on some of your language in your reports that we've had the policy bazooka back on the 24th of September, the weekend felt more like an after party. We had a feel-good factor, but I think investors were looking to know exactly what sort of tonnage was loaded into the machine, what type of fireworks and just how many there were. But we didn't get that. Does that make a difference to you?
No, I think patience is warranted. I believe that Chinese authorities wanted to start out tackling the challenges facing the economy first, as in particular addressing the local government's hidden debt issues as well as the housing turmoil before they would go through the NPC towards the end of the month to finalize the stimulus measures. So all in all, I think we are happy with the beginning of this fiscal easing process, but I think it would take slightly longer than market speculation in order to see those come through.
Raymond, the big question is whether we see a pickup in credit demand here, whether the measures are enough to drag some of those investors off the sidelines back into markets being more active. What do we look for here? Do you think we are going to see those animal spirits return when they've been so cautious thanks to the lingering property market issues and some of the problems with the overall growth of the economy, trade tariffs, geopolitics, external demand issues?
Yeah, I think what's incrementally positive coming out of this press conference over the weekend was that over 2 trillion yuan of idle capacity will likely be used to purchase undeveloped land and unsold homes in the ensuing months of the year. So that should help alleviate to a large degree the housing problem that have been limiting the economic growth. And as confidence revives, we are hoping that consumption will also start to see a pickup as well.
Raymond, I mean, having just a stronger income growth, perhaps a robust jobs market, as well then as that stabilized property market, as you make note of, is probably going to be very important to garner up the confidence for consumers to actually spend a little bit more. And if you don't get that, the 5% growth rate ultimately becomes at risk, doesn't it?
Yep. I think what has been announced is certainly reducing the downside risk to economic growth. We have yet to see more of the incremental stimulus to really help improve growth prospects in the near term, right? So what is light coming out of this media conference over the weekend certainly would lie with the consumption side of things, where we did not see much in the way of incremental stimulus towards driving consumption growth. So that is something that we believe is quite critical. In the next couple of weeks, as we go into the NPC meeting, we certainly would look forward to hearing more of that, and also specific measures to really improve the employment situation. As after all, as you pointed out, unemployment growth facing youths is at pretty high levels still.
Yeah, so, I mean, does that mean that we should anticipate then a kind of tinkering with policies then over the next couple of months or so as well? One, into the end of this year, but certainly into next year as well, to ensure that that consistency of growth perhaps is maintained somewhat?
Yeah, we believe that there's a reduced downside risk for GDP growth this year. But in terms of next year, I think more of these stimulus measures will be required to make sure that consumer confidence will pick up, while trade growth would likely moderate from here on. Right. I think a key risk factor to watch out for is also extra trade tariffs and or sanctions that would emerge from the U.S. presidential elections in a few weeks' time.
Raymond, can I ask you about the consumer and animal spirits here? Because there have been very few investment options, given that the stock market's been stubbornly weak for a long time until recently, the property market issues that we've been talking about. The fact that we had such a strong rally in the Shanghai Composite from a low base, does that make a difference for consumption habits if some of these investors have been dragged into speculating on the stock market lately?
Yeah, I think so. I think that the positive wealth effect would certainly help translate into incremental consumption growth over time. But we need the equity market rally to be sustained, right? For the time being, we think that A-shares has already had a pretty decent rally since the end of September. But we believe that if we have more clarity on fiscal measures, usually onshore equity market tend to outperform the offshore equity market because it's, after all, a policy-driven equity market.
Raymond, just to wrap all this together, what are the chances that China actually hits its 5% growth target? I know some people were more confident after the weekend. They thought there was a possibility that the mainland market can get there. What are your thoughts on whether 5% is at all achievable?
Authorities seem fairly confident, right, over the weekend to express that they have ample room to really achieve that growth. And if there's need, they will come up with incremental measures. So from our point of view, we are more concerned about the revival of consumer and also investors' confidence in the next 12 to 24 months. Because after all, it's not just the consumers that have been seeing a lack of confidence. It's also the business confidence that is lacking as well. So as we hear more about fiscal stimulus, how the authorities are trying to drive strategic growth in particular industries, we think that business spending will pick up, which would ultimately support employment opportunities and consumption.
Raymond, thank you very much for joining us. We do appreciate your analysis after the weekend events. Raymond Cheng with our CIO, North Asia, Standard Chartered Wealth Solutions. Arabile.
Well, let's give you what's coming up on the show. Of course, Japan's closes today. Actually, earlier on I said Hong Kong, in fact, then it's actually Japan. And it's Sports Day out of Japan then, so commemorating the 1964 Olympics there. But what is coming up? Well, we're going to kick off earnings season with stronger than expected profits then. We'll break down the details of all of that next, because that surprised markets. The UK government's also hosting their investment summit, which kicks off then today. It's overshadowed a little bit by a row with over working practices. More on that then throughout the show. Also, we'll dig into the outlook for Europe's auto sector at the Paris Motor Show, including a conversation with Dacia CEO Denis Levant. That's coming up at 7:15 London time. Stay tuned. Welcome back. The number is 45. Why? Well, that's the number of record highs we've now seen for the S&P 500. Another gain then on Friday, 0.2% to the good ultimately, off the back of the numbers that we saw out of some of the banking stocks, particularly JPMorgan, Wells Fargo, and even a bit of BlackRock there came through as well with some of its numbers, right? So at first glance, looks like the banking sector isn't faring too badly at all then. Kicking off the third quarter earnings season is what we did then just last week on a high note, that is. And so the market certainly followed then. It pushed the banking stocks high. In fact, the financial sector index also hit its own record high then as well. S&P 500 pushing past 5,800 points then to close off the day's trading for the first time. Even the Dow Jones actually reached a record high of its own, nearly 1% to the good there. Of course, next up then will be Bank of America, which we'll be looking out for. Goldman Sachs, Johnson & Johnson all set to also put out their numbers then. That's anticipated tomorrow. Of course, today being a holiday then, stateside Columbus Day, that is. Morgan Stanley, United Airlines also set to release results, then that's set for Wednesday. Netflix is also on the horizon. Big question marks, though, will be still on rates. Despite markets hitting those new highs, we have seen yields move higher as well, around 4%. So election risk still certainly at play here. Let's move on to your currencies then here as well. The dollar extending some of its gains then, with Japan certainly on holiday, sapping some of the liquidity then perhaps out of the market there. That has left China's weekend stimulus program to be the main focus area then for the market. Currency moves in major markets were a little bit tepid last week, particularly because you saw the yen and the euro both actually drop around 0.3% there. Sterling shedding 0.4%. The dollar index itself, though, managing to inch a little bit higher. So you're seeing sterling 130 as we head into that investment conference then for the UK government there. Dollar yen 149.28. Karen.
Bilal, let's push on to the banks. It was a strong showing from many of those lenders on Friday. Better than expected profits from some of the largest banks helped push the sector to its highest level in a year and a half. First out of the gate, BlackRock. Earnings per share and revenue both beat expectations, while record quarterly net inflows helped push shares to a new all-time high. JPMorgan also beat on the top and bottom lines and raised its full-year net interest income guidance, sending shares more than 4% higher.
Now, shares in Wells Fargo touched a new record after a 37% jump in investment banking fees helped to offset what was an 11% annual decline in net interest income. Octavio Marenzi is the CEO at Optimas and joins us now. Octavio, thank you so much for the time. I mean, what was all the worry about? Previously, before this, the sentiment was, well, we're going to downgrade a lot of the earnings sentiment here. And judging by what we've seen so far, it looks relatively good. Is that the case?
Well, I think so far it looks really good indeed. And I think one of the most interesting points actually about these bank earnings is what it says about the broader US economy. So as you delve further into it, one of the things that's, of course, very important are the charge-offs or the losses they take on their loans. And those seem to be very, very modest indeed. And I think even more surprising was at Wells Fargo, where you saw this actually came down now. They reduced their provisions for loan losses. And they've got a fairly risky kind of portfolio, people would have thought. A lot of commercial real estate there, big real estate exposure, and that seems to do very well. So I think we're tempted to look at this and say, well, the US economy in general seems to be in very good shape and does not seem to be slowing down at anywhere near the pace that might have been expected.
Is that same US economy also the biggest risk then for the lenders themselves? That yes, it's still looking fairly good right now, but if it was to turn in any direction right now, that could offer a fairly negative picture then for these lenders?
Certainly, if we see the US economy turn down, we're going to see a much, much higher rate of charge-off on the lending portfolio. Unclear what that would mean for the sort of the market investment banking side of things and some of the commercial lending. But yes, we certainly see a big deterioration in terms of the profitability of those banks if that would happen. But it doesn't look like it's anywhere on the horizon. So we've been talking about the slowing economy now for as long as I can almost remember now. That things we're going to see a big uptick in write-offs on portfolios in terms of credit portfolios, and in particular on credit cards. Now, credit cards, we have seen some uptick in terms of how many people are not repaying their loans there, but it remains very, very low historically and very, very manageable, I think, for these large banks.
Octavio, let me just bridge from this to net interest income, because some of those metrics actually went up, which was extraordinary given we've had a rate cut, but it's the repricing of some loans that start to kick in. And much to the frustration of Jamie Dimon, there were a ton of questions as to where these margins are going, because for this year they gave guidance more than expected, actually 92.5 billion. But for next year, big question mark. And, you know, they're holding back in terms of what that number is going to look like. What do you make of how significant NII will be from here?
Well, it's an absolutely crucial factor for these banks in terms of the net interest margin. We're sort of in an interest rate environment where it's very hard to say where the Fed is going to go next. I think we're actually looking at this now and saying that the 50 basis point cut that we saw in September might have actually been premature. We don't see any signs on the horizon that the US economy needs that kind of boost, and certainly the markets don't. As you well know, we're at record highs right now. It doesn't seem like the right point for the Fed to step in and say, yes, we need to support markets, we need to support the economy now with an interest rate cut. So I think we might look back at their 50 basis point cut and say that was premature. I think the odds that we get another small cut in November are still there, still on the books. After that, I think the Fed is going to sit on its hands for a while and say, well, we've jumped into this a bit more quickly. Inflation is not coming down as quickly as we expected. The economy is more robust than we thought. The banking sector is doing pretty well. All those things point towards the Fed not cutting rates anymore for the next few months after the November meeting. So we'll see what they actually decide to do in that. But I think that would be where the balance of the risks is now, that we see no further interest rate cuts, and the markets might not really like that and appreciate that much.
Octavio, we have had this deepening of the yield curve, though, which should help bank profitability. But to the point around what happens next, I've heard everything from, we could still have a jumbo-sized rate cut down the track. We wouldn't rule it out, maybe for this year, but perhaps not next year as they play catch-up. How unusual is this cycle? Because if you've got businesses and consumers wanting to take out loans and they can't judge where the Fed's going to be, doesn't that impact the process somewhat?
Definitely. There's a lot of uncertainty at the moment around where interest rates are going. So I think that's unusual in a certain sense. That I think a lot of the macroeconomic indicators point one direction, the Fed is saying something else. That's causing a certain degree of confusion. And that is unusual. Usually you know exactly what the Fed is thinking and what direction they're going to go. And bear in mind, they tend to, once they start to move in one direction, carry on moving in that direction for a year or 1.5 years or maybe even 2 years. So once they start a cutting cycle, they will carry on that typically. And once they start a raising cycle, they will carry on doing that for a couple of years typically. Now in a situation we say, well, I'm not really sure what they're going to do next. It doesn't look like it was a terribly good idea to start to cut so soon.
Octavio, what about those loan losses? I mean, yes, it's been declining steadily, and it showed some resilience even in this one, in this report as well then. I mean, how big a worry does that perhaps become then at a later stage, just because you can continue to drag out consumers a little bit more at a stage like this, especially if rates do remain high for just that little bit longer as you put forward?
Well, it's certainly always a concern what's going to happen with loan losses. But if you look at the numbers overall, I mean, JPMorgan was saying that they're now forecasting on their credit card portfolio, and that's typically where the losses are the most severe and intense and sort of start to appear the earliest, is basically consumers start to default on their credit card loans. They're only about 3.4%, and historically that's a pretty low number. So if you go back to prior recessions, excluding the COVID recession, which was very, very unusual because we saw charge-offs actually come way, way down there as government largesse basically sort of finesse that a bit. But if you go back to prior recessions, we've seen credit card charge-offs go all the way up to 10-12%. Now that's, you can absorb that, I suppose, when you're charging 20% interest on those credit card portfolios. But so 3.4% for the year, we're still pretty low. We're higher than we were a year ago. But it's a very, very low number, a very, very manageable number, historically speaking. So I think, yes, there's always concern about that, but it looks like those concerns are not very well placed right now. It looks like everything's basically fine on the credit card side.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.